On this episode of Systematic Investing, I will update you on my first year of investing on M1 Finance. Welcome to episode 1 of Systematic Investing, where we will look at what led me to start investing with my broker, M1 Finance, and my current investment portfolio. You can check out my original Reddit post in the description below. My journey started in March of 2019 when I came across the Tony Robbins book, Money Master the Game. Here are a couple things I took away. First, you must reduce fees as much as possible, as they kill your ability to compound returns. Next, you need to pay yourself first by automatically taking a percentage of what you earn and invest it so that you never see it as money you can spend. And the importance of asset allocation and diversification. So in May of 2020, I was sitting almost at $7,000 with a 14% total return. Fast forward to July of 2020, I'm sitting closer to $10,000 and my money weighted return is now 26%. I was able to add an additional $2,600 during this time period. I have also made a slight portfolio tilt to gold. My investment strategy is largely based on Ray Dalio's All Seasons portfolio from Money Master the Game, not to be confused with Bridgewater's All Weather Fund. Ray Dalio defines 4 economic environments in which this strategy seeks to balance risk. You have inflation, deflation, increasing economic growth, and decreasing economic growth. We don't know which economic environment is on the horizon, but we seek to be prepared for all outcomes through a balanced, diversified asset mix. Investors must understand that there will be drawdowns every year on average and mentally prepare for the inevitable. So what is risk in this context? Risk is equal to volatility, which we measure using standard deviation. The standard deviation is a measure of the extent to which actual returns deviate from the average return over a certain period of time. The All Seasons base strategy consists of 40% long-term bonds and 15% intermediate-term bonds, which counter the volatility of stocks. The tilt to longer-term treasury bonds is also a hedge against deflation. Next, we have 7.5% in gold and 7.5% in a basket of commodities to hedge against inflation. And finally, equities, with 30% in stocks, which provides strong returns during times of prosperity. As each of these asset classes excels in different economic environments, there will always be at least one great performer. So what are my current portfolio positions? You can check out a link to my portfolio in the description below. As you can see, my current portfolio is modified from the base all-season strategy as I have shifted some assets. My portfolio mainly consists of ETFs as they satisfy my exposure needs. I have also added the US Quantitative Momentum ETF into my equities bucket. So where do we go from here? In future videos, we will look at ways to take a systematic approach to invest in the stock market. Having a clear and consistent plan allows us to stay ready for any hurdles the market or life can throw at us. If you liked this video, hit the like button for the YouTube algorithm, and to stay up to date with the newest content on this channel, hit the subscribe button.